Good morning, and welcome to episode 290 of Getting Rich. I'm your host, Rich Checkin, president of Asset Strategies International, and today is Wednesday, August 19th, 2026. Ships from U.S. Gulf allies continue to come under fire in the Strait of Hormuz without U.S. retaliation. In addition, President Trump has announced that he will be scaling back military training exercises in South Korea. Both moves have given our allies pause that the U.S. is lacking resolve as an ally. Both public and private debt are showing signs of strain. On the consumer end, although overall debt is down to 18.8 trillion and credit card debt is down from 1.28 trillion to 1.26 trillion. Auto debt at the consumer level is up to 1.71 trillion, and delinquencies are sitting at 4.7%. On the public sector, 30-year Treasury yields are up to 5.34%. That's the highest yield we've seen on the 30-year Treasury since 2007, and it is giving borrowers, buyers of U.S. Treasury, pause that the U.S. has the ability to repay. U.S. debt overall currently stands at 39,942 billion, just under the 40 trillion mark. And meanwhile, gold and silver have taken a pause in their recent run up. Let's take a look at the overall prices in the precious metals over the past week. Gold is down 1% to $4,367.90 an ounce. It was $4,411.20 last week. Silver's down 4.4%, trading at $63.46 an ounce. It was $66.41 last week. Palladium's down 2.8%, down $50 to $1,737 an ounce. It was $1,787 an ounce last week. And palladium, the big loser in the metals complex, is down 7.5% to $1,313 an ounce. It was $1,419 an ounce last week. With gold falling less than silver, it's going to take more ounces of silver to buy that ounce of gold. Your gold-silver ratio is up to 68.83 this week from 66.42. And the U.S. dollar is down slightly, weakening on the legacy index against our major trading currency partners. It's trading at 99.36. It was 99.85 last week. All belief in the market among investors is that the Fed is likely to hold rates steady again at the September 15th and 16th Federal Open Market Committee meeting. That's as a result of weak retail sales, soft consumer price index, flat producer price index, weak consumer sentiment, and a 2.3% drop in July pending home sales. All are signs that the economy is clearly not overheating. Meanwhile, given that potential pause in the fears of rate hikes and the fact that we're moving seasonally into the fall, a fantastic time traditionally for precious metals prices, we would expect precious metals to rise over the next several months and throughout the end of this year. My question for you this week is, where do you see gold by the end of 2026? I'm interested in hearing your thoughts there, as well as why you think we might get there, whether it be up, down, or staying the same. As always, we'd like you to go ahead and subscribe to our YouTube channel. Like us, send us your comments and questions. We can address them here on the air when you do. Follow us on social media. Take our twice weekly, always something interesting alerts and our once monthly information line newsletter. But in the end, don't ever forget, getting rich starts with keeping what's yours.